Hey everyone, welcome to the Everyday Trader. This is Greg. Glad to be back with you. Eric, pleasure.
It's a pleasure to be here too. And I've only had 3 cups of coffee today, so I'm a little bit more mellow.
That's good. That's good. I'm feeling a little more mellow today too. So, what we wanted to talk about today was a mistake that I think a lot of beginning option traders make in regards to call options specifically. And I know there's a lot of stuff going on in the market today. We know we've got a big Fed decision. We'll talk about that later in the week. In fact, we're going to do another recording probably on Friday after we get both fallout from the Fed meeting. We get Apple's earnings, we get Google earnings. So we'll have a lot more to talk about on Friday. But for now, we wanted to talk about a concept that I think, like I said, a lot of option traders make a mistake early on in their trading, and that is not really understanding how call options specifically work, specifically in regards to should I exercise them. So, Eric, I'm going to let you talk about this for a little bit. I know you've kind of put some data together on here to share with people.
Sure. Just a simple sort of discussion around this and sort of frame things out. I think this is where most option traders start. You and I were talking ahead of time. My very first trade was long calls. I traded stock before and I wanted to start getting into options. And so kind of understood that there was this thing out there that allowed me to benefit from moves up without spending as much money as you would on stock. It was your first trade too, right?
It was. In fact, the company was iOmega.
Oh,
That shows how long ago it was. You remember the guys that
wow.
made the like blocky
Yeah,
disk
yeah,
drive?
yeah. Yeah, the zip, was it zip drives?
I think it was zip drive. Yeah, that was I
Zip
think.
drives, right? Yeah. Remember those? Jeez. Like, golly, it's amazing how far we've come in storage. I probably have some of those in a box in my closet over here someplace. Who knows why? Probably, yeah. Anyways, probably Windows, not even Windows, probably MS DOS. Long time ago. Bringing back some memories, Greg. So long calls is where a lot of people start trading because it allows you to get exposure to a very bullish move, and they're relatively low capital. Here's an example of a long call. This is a risk profile for me. You know that I have dyslexia, so for me, being able to look at pictures is a lot more helpful than numbers. In fact, before this we were going through some math stuff, and sometimes it's not that I'm not smart. Sometimes I get confused about numbers. So I like looking at risk profiles here. This allows me to look at where I can make profit. Risk profiles have stock prices on the x-axis and my profit and loss. And so this,
By the way, do you have it up on the screen? Because I don't see it yet.
no, it's in my head. You should be able to read my head. You can't read my mind.
Well, sometimes I can. We've talked
Actually, that's scary. That sometimes.
Yeah.
Let me share the screen. So this is a risk profile of a long call, showing me where my max risk is, where there's no limit to the profit. This can make infinite amount of money, just like stock. Shows me where the stock is trading now, my P&L. And so there's lots of information in here. This trade, this particular one, $437.50 is the most you can lose. And there's really no limit to how much money you can make. We could talk about whether or not that, that asymmetrical risk, when it exists, you tend not to have good probability. And I think that's probably what you discovered when you were trading options as well, is that, hey, I'm not using as much money, but your reliability in terms of trades, you probably had less success making money from options than you did with other strategies.
Yeah, because the problem with long options as a trading tool is not only are you dealing with, you have to get the direction right, which is hard enough sometimes in the market, but you also have to get timing right. You can sometimes be right on the direction, but if the direction is too slow and you experience time decay in your option, you can actually still lose money in your trade, even though you bought a call and it went up and you were supposed to make money, but you lost time decay.
Yeah, I have a
So
very vivid memory of when Apple released the iPhone. I don't know if you've heard me tell the story before, but I bought short-term long calls that were at the money, um, just days till expiration, and Apple released the iPhone, and the stock went up $6.40, and my calls lost money. So it wasn't just time. There's another factor, and there's implied volatility. But what I wanted to talk about is probably a mistake that I see made with options, because the long call is a right to buy stock. When you buy a call at 140, no matter what the price of the stock is, you have the right to buy it for 140. So if the stock is 142 or 150 or 200, you still have the right to buy the stock at 140. And I think having the right and following the right is where the mistake is made. And I was going to pull up just a quick and dirty spreadsheet here, nothing really terribly complicated, but I wanted to show what the math looked like in terms of exercising, because that's the mistake that people make. People will exercise options to take ownership of shares when there's a more profitable approach that's out there. So this is an example. This is pricing right now before we started presenting here. Apple's trading at 141.95, and the February, this is one that expires here at the end of the week, the 140 call, which is lower. So I could buy the stock for 140. The stock is trading at 141.95, and the price option is $4.40. So I ran through the math here to show that if I were to exercise, so it's a debit transaction, 440, exercising the stock to buy it at 440, my cost basis on the stock works out to be 144.40. It's the price of the stock that I pay and what I paid for the call. And if I turn around and sold it where the trade is, I'd end up losing $2.45. And you and I recognize very quickly what that number is. That number, when we think about option pricing is made up of two components. Take it, Greg.
well, it's made up of two components: intrinsic and extrinsic value, right?
Intrinsic and extrinsic value. Very, very basic, very important. Do the math for me. What's the intrinsic value?
Yes. So the intrinsic value of any option, in a call option in this case, is the difference of where the stock is trading. So 141.95 versus where I have the right to buy the stock 140. So the intrinsic component is $1.95. So the rest,
but it's not trading for 195, right?
Right. So the rest of that value, the $2.45, the extrinsic component is made up of a slew of different things. It's made up of time. It's made up of volatility. It's made up of gamma. There's all kinds of different components. In fact, that's kind of the basis.
Dividends and risk-free interest rate too.
Right. Dividends and that's the basis of the Black-Scholes options pricing model that is the most common one used to price options in the market today, or at least theoretically price what an option should be worth. Really, an options price is simple supply and demand, but that's way too simplistic. We're getting to Occam's razor there. But there's a lot of things that go into that component. Call it fluff, call it excitement, whatever. It's extrinsic value.
And I always remember that. I remember the two terms intrinsic starts with the word in. So how far in the money is that option? That's how I remember it. And it's the difference. This call gives you the right to buy the stock at 140, which is $1.95 lower. So I know it's in the money by 195, but the price is 440. So everything above and beyond that is the extrinsic value. And as Greg pointed out, in this case, if you did the math, the difference between the 195 and the 440, what is trading, is 245. And those of you that are astute enough notice that number right there is 245. Here's the key takeaway. A little bit of dramatic pause. When you exercise your right to buy the stock, you will lose the extrinsic value of the long call. When you
Correct.
exercise a long option, it's the same thing with puts too. So when you exercise, you'll lose the extrinsic value. So it's a very easy calculation for you to know what the extrinsic value is. Now we're neglecting transaction costs here too, because this is actually two transactions, or exercising is one transaction. The other thing you could do out here, probably the smarter thing to do, would be if you wanted to close the trade and maybe you bought this at another price, but you could sell the stock and sell your call together. Almost always a better transaction than exercising, or I'm sorry, buying the stock and selling your call. If you wanted to acquire shares, you're almost always better off not exercising. You're almost always better off, I'll sell my call and buy my stock. So exercising doesn't make sense. But Greg, when does it make sense?
Really, the only time it makes sense is when that extrinsic component that we've been talking about, that fluff, gets so minimal. And it doesn't have to be zero when it makes sense. But what it does is it gets so minimal that your expectation of the next move is bigger than the extrinsic value. So if you think, and maybe 245 is that number because they have earnings tomorrow, and you're thinking, you know what, I actually want to take the risk and own Apple shares. And so I'm going to exercise that because I think the move tomorrow is going to be bullish, and I think it's going to be more than 245. And so you may do that. I still will go back and argue what you just said. From a math standpoint, it probably, if you really truly believe that, you still probably are better to just go buy the stock.
Right.
Well,
there is one other place where it makes sense, and that is around the ex-dividend day.
Yeah.
Is if you want to get the dividend, and I find most retail traders tend not to do this, but if the other person, like if you have a short call, you did a covered call maybe, or you did some call spread and you own a short call, and somebody is on the other side of an in the money call, if the dividend is greater than the extrinsic value, it's a no-brainer to cap, because the day before the ex-dividend day. So the ex-dividend day is the first day that an option trades without paying a dividend. So you need to own the stock the day before. You can own it the day before the ex-dividend date, sell it on the ex-dividend date, and you will get paid the dividend. So there's a special case where it makes sense, if you want to capture that dividend, to exercise the call. And this normally happens, and I think it's mostly retail trade, or not retail traders, institutional traders who are doing it on the other end, because sometimes dividends are pretty small, and retail traders, I don't know that they always do this. I've found about 75% of the time when I've been in this situation where my extrinsic value is small and the dividend is big, that I've been assigned early. So when you're assigned, that means somebody exercised on the other side. So that's the only time that, well, I think there's two times. One is when you really think it's going to go up, and you really want to get the stock to take advantage of that bigger move, because you will have a higher delta when you own the stock. The other is to capture a dividend. But I wanted to point out one other thing, and that is when you're selling calls. So if you're selling calls, a lot of people will ask the question, when am I going to get assigned? And we know on expiration, when it's in the money, you'll be assigned. 99% of the time, you'll be assigned. I've had a weird case where I didn't get assigned once because the stock had a big move after hours. It dropped 20% after hours, and I ended up not getting assigned. But very rare situation. Don't count on that. But sometimes we get assigned early when it doesn't make sense. And when does that, why, how do you explain that? People have in the money calls and they say, when am I going to get assigned? We never know, because there's a human on the other side. But have you ever had that happen? A short call gets assigned out of the blue? You didn't expect it?
Yeah. And other than, I don't know that there really is an explanation to say why. It might just, again, what it's coming down to is there is, like you said, another human on the other side who's saying, I'm willing because I think it's going to move, and I'm going to pay that extrinsic value to exercise.
Well,
and it might be that dividend again.
But sometimes it's happened when there's no dividend, and so you pointed that out. Sometimes you don't. It doesn't make sense, but it happens. And a couple key points I wanted to emphasize on what you said there is, you don't have the right to know why somebody, if you're selling options and you're on the other side and somebody exercised, you don't have a right to know why. It's happened to me before, and I called my broker and said, I don't understand why did this happen? They're like, it did. That's like, it's not your right to know. Like, well, who did it? You don't get to know. None of that. And the key you said is that it's a human, and sometimes humans do stupid things, or not smart things, and they exercise when they shouldn't exercise. So if you have short options that are in the money, it might not make sense, but it actually should work out to your benefit. In fact, if you do your P&L, you're the one who captures this 245 goes to whoever has the short call. So your P&L would be 245 better than it would have been otherwise. But on short options getting assigned early, there's another explanation for when and why it happens. And that is, it's not that it's stupidity or people making mistakes, or maybe it's a mistake in another kind of way. Some people trade on margin, or maybe they get close to their buying power limits, and then they have things happen in their account. And your broker has the right to go in and place transactions for you. And let's say maybe you had short stock and you got a call, you got a margin call because the stock went up. You would buy to cover the stock, or if you already have a long call, your broker might go in and exercise the long call for you. And there are a couple brokers who are known for doing that. Interactive Broker talks about their risk management process 4 times a day. They go through their clients' accounts and they will automatically make adjustments to people's portfolios. So you could be on the other side of that by accident, having a short call get assigned to say, wow, there's tons of extrinsic value. There's $2.45. I shouldn't have to worry about being, well, in this case, you're long. But if I was on the short side, then I shouldn't have to worry about delivering shares. But you might get a call to deliver shares because somebody had something unfortunate happen to them on the other side. So the key is, if you have short options that are in the money, you need to understand the consequences of early assignment, because we as traders don't get the right to know why somebody does what they do, and somebody could do something not smart. So having an option be in the money is not a reason to panic, but it absolutely means that you need to have a plan for what happens when you get that phone call or email from your broker that you've been assigned and now you have to deliver shares.
Absolutely. It's one of those learning lessons that we're hoping to share with you, that, we've been through that, game before.
Yeah, it's not that complicated. This is about the worst thing for buying long calls. I think the worst thing you can do is probably exercise early. I guess the other thing you can do is hold them too long. And that's kind of another sin, is not taking profits. I don't know if this risk profile drives it home, but this is showing that the green line shows where the profit is today, and I'm making money. If the stock goes up, I can make money. But even if the stock goes up, my break even on expiration isn't until we get to 144.38. The yellow line is on expiration. So if the stock is just hanging out here, if it goes up a little bit and I could have made a profit, and here I'm making $100 if I close the trade today, but if I wait, I'll lose $90 all the way to expiration. So that's kind of that's not really forgivable. That's a common mistake, is people make money on long calls and don't take profits when they should. And that goes to what we talked about, I think, in our previous, just the video we did just before that. It's the most important thing.
Yeah. Exit points, right? Having your exit points defined.
Yeah. So determining you've got a long call. By the way, you shouldn't make money on long calls. They're low probability trades. So if you are making money, you should really be thinking about, should I take my profits now? And so getting ahead of time, saying, what is my goal on this trade? So $440, if I can make $100, that's close to 20% return on risk. You should probably take the profits if you make a 20% return. Otherwise, you might find yourself on the other side because it's more likely you're going to lose money.
Rolling an 11 on the craps table isn't high probability either, but it's fun.
But we've seen people do it 3 times in a row. Maybe we should get on the C&E. C&E, come on, roll.
Well, hopefully you guys got some benefit from today. If you have any questions about any of the stuff we've talked about, feel free to ask them down below. Like and subscribe, and hopefully, like I said, we'll put another one of these out here in a couple of days and talk about what's actually going on in the market right now.
Big week, big earnings, Amazon, Apple, FOMC, ECB, I got the jobs report on Friday. There is a boat ton of stuff. It's a time to be vigilant right now, people, because there's a lot of things that are going to move the market. We'll talk more about sort of market stuff on Friday, but I'd like to hear what ideas you like. What other topics are you interested in? What don't you understand? We kicked around the idea of talking about these 0 day to expiration options and explaining what's going on there. It's getting a lot of attention, and retail traders are jumping on board. Not that it's a bad idea or anything, but I mean, we know what's going on behind it, and it probably would help some people who are to better understand why it's going on.
Yeah, let's do that.
Yeah.
Okay. Till next time. Thanks, everybody.
All right. We'll see y'all later. Bye, Greg.